Welcome to S&P Capital IQ's quarterly loan market update. I'm Ruth McGavin, a member of the Leverage Commentary and Data team in London. By the numbers, 2014 looked like a pretty good year for the European leverage loan market and for the high-yield bond market too. Fourth quarter institutional new issue loan volume of 13 billion pushed the full year total to 49 billion in Europe. Add to that the paper syndicated to banks, and the annual total reaches a very respectable 78 billion. On top of that comes the record-breaking 72 billion euros of high-yield bond issuance, to drive European leveraged finance issuance to 150 billion for the year. So, a good result all in all, but the way the year wrapped up and the macro news in the early days of 2015 puts the market in a slightly precarious position, and issuers may find conditions somewhat wobbly in the coming months. I'm going to take a look at the push and pull influences at work in Europe as the new year gets underway. On the positive side, CLO creation expanded confidently during 2014, putting in place a stable core of asset takers dedicated to the European market. The pipeline for further 2.0 CLO issuance in 2015 is strong and should support primary loan activity as the market revs up again. During the fourth quarter of last year, appetite from CLOs and other buyers met a steady but not overwhelming stream of new issuance, leaving the supply-demand dynamics more or less in balance. Clearing yields were steady at around the 5.5% mark for single B issues, while the number of deals flexed up and flexed down was approximately equal. Despite oil-related volatility in the fourth quarter and the drag effect on the average bid caused by large defaults during the year, the S&P European Leveraged Loan Index returned 4.47% in 2014, easily outstripping the US, which returned only 1.6%. If defaults in Europe stayed subdued in 2015, as market players predict that they will, and CLO issuance fulfills expectations and continues to grow, the European market is set fair for a strong year ahead. Added to this are hopes of an improvement in the pace of M&A to help rebuild the volume of outstanding debt in the market, which shrank last year to just 98.3 billion as per the ELI, the lowest in over a year. However, this well-poised and well-positioned market continues to face external factors that could disrupt demand. Firstly, the renewed possibility of a Greek exit from the euro. Secondly, broad volatility across the financial markets arising from the collapse in the oil price. And thirdly, the generally weak state of the European economy. In addition, technical volatility could be imported via the relative value play with the more reactive US market. The immediate impact of the first of these on European leveraged loans is small. There are few Greek companies and few oil production firms in the borrower universe. But Europe cannot expect to be completely watertight against storms overhead. As the chart shows, the secondary market was already unsettled in the fourth quarter, and both buy-side and sell-siders expect more peaks and troughs in the coming months. This brings me to the end of my market review. I hope you found it useful. You can download the slides at slideshare.net. If you'd like to know more about the leveraged loan market, you can follow LCD on Twitter, Facebook and LinkedIn, or you can visit our free websites, leveragedloan.com and highyieldbond.com. The links are all in the info section on our YouTube channel. Thanks for listening. I hope you'll join me again next time.